It's an urgent warning. I'm your host, Steve Metre, and thanks for joining me today. In our show today, Bank of America just issued an urgent warning to all of its customers, and it doesn't matter if you bank there because it applies to everyone, as their lead analyst just issued a research report showing that everyone is completely mispositioned. We'll show you how people are positioned right now, why it doesn't make sense, and why Michael Hartnett says it's time to make a change, because this is why every Sunday we like to look at the technicals, momentum, and machine positioning of the broad equity, bond, currency, and commodity markets to help you be on the right side of the market. Now let's head over to Bank of America. Let's see what they've got, because global research headed up by Michael Hartnett, again, one of the top analysts in this country, says a Q4 pain trades and inflection, they're coming. Let's take a look at the big picture here, because we have 26 global rate cuts in September, the fourth biggest monetary stimulus of this century, and yet the long end of the yield curve is not unhinged by inflationary movement yet, but that is coming. And what he's warning here is everybody is completely mispositioned. There's a massive pain trade coming for investors. I'm going to show you what you need to do. But let's take first look at how B of A clients are invested. We see $3.8 trillion in assets under management and 62.6% in stocks. That is on the upper end of the past range in 20 years. So what we're seeing here is investors are long the U.S. equity market. But when we look at the machine positioning, we look at how institutional investors, and we're going to look at corporates here, you're going to see that this is the wrong trade, because what Hartnett's been warning is people should be more in bonds. We see 19.8% allocation to bonds. That is very low at the lower end of the range, and cash allocation also at the low end of the ranges. Again, everyone's piled into stocks. Now, I know many people are big on metals, but yet client allocation to gold and physical ETFs just remains 0.2% of total AUM, very low. And here you can see where is money flowing right now. It's going into REITs, or real estate investment trusts, and financials. We're going to take a look specifically at those two sectors, because I think there's a lot of mispositioning and misunderstanding on what rate cuts due to those sectors, which is again why Bank of America is sounding the alarm, because if their customers are doing this, imagine everyone else is likely doing the same. And here you can see the equity allocation sitting right at 63%, remaining at one of the highest levels as investors pile into stocks as a safety trade here, believing that when the Fed cuts rates, stocks only go up. But let's take a look at what Goldman has to say, because something that's really important is looking at how machines positioned here, because a lot of people don't realize the market is being moved by two large forces. One is corporate share buybacks. We'll look at that here in a moment. And machines. Hundreds of billions of dollars is just being algorithmically traded by machines. It's important to know where they're at and what they're up to, because as we turn to the Goldman Sachs tactical flow of funds, what we see Scott Rubner saying is he's bullish on U.S. equities for a year-end rally. But that doesn't start till the end of the month, he says, and he's worried that his 6,000 target for the S&P 500 is too low, but he remains tactically bearish on U.S. equities over the next 3 weeks. And why is that? Because we looked at last week what happens going into elections in October. You usually see the rug get pulled out of the market, an air pocket, and stock prices come down. It's not till after the election that you start to see a rally in equities and a rally in bonds, and it doesn't usually matter who gets elected. Usually interest rates go down, and particularly when we see the yield curve uninverting and heading into a bull steepener, tells us the trade for bonds is looking good as well. But let's talk about how the machines are positioned here, because they are very, very long the market. We've been warning about this. What that means is even if the market doesn't move much, you can see here less than $1 billion going into U.S. equities over a flat tape means stocks don't move, or even an up tape if you see further rally. And what this means is machines here are all invested. They're fully in. And what happens is the longer they're at these peak levels, their trigger to sell rises every day. And that's the warning sign here. You see Goldman noting in downtime they could be big sellers of global equities, about 145 billion. with 50 billion of that out of U.S. equities, suggesting that any sort of air pocket in the market could lead to selling. When we look at total systematic positioning shown in blue against the S&P 500 in red, this takes a look at those CTAs, risk parity models, and vol control funds. What do we see? They're not at all-time extreme positions, but they're up there. And again, the risk here is an air pocket, which usually happens going into the election would be backed by machines cutting and burning and selling here in a big way. But how about institutional investors? Because we know retail investors are all in. We know machines are all in. But how about institutional investors? Well, mutual fund cash levels are so low now that they don't have room to add. As U.S. equity mutual fund cash levels, a percentage of total assets is the lowest level on record at 1.5%. So here you see, as B of A is warning, and what Hardin is saying here is everybody's loaded into stocks. Huge risk here. Now let's take a look at the technicals, momentum of the market, because we looked at machine position. We'll get into the bonds here of where B of A says you should be looking to put some money. Because as we look at the S&P 500, we see momentum is broadly positive. Now, how do we know that? Well, we run a momentum screen. We take a look at technical signals like the relative strength index. We want to see that over 40 to show momentum is positive. We look at the moving average convergent divergence. We look at the moving average convergence, divergence, or MACD. We want to see a positive cross. Right now, we see a negative cross, but what we do is we take these signals and other signals, run a proprietary overlay, and we look at daily momentum. That's shown down here. It's called Momentum Timer Pro. We look at a 1 month, 3 month, and 6 month window as well, and we see that momentum is maxed out on the 1 month window and very high on the 3 and 6 month. So what it's telling us, momentum for the market's extended. Now, machine positioning, we mimic that too. We have a fast algorithm which trades among against some of these other reports, and then the slow algorithm is very similar to Goldman's. We've been leading them because we run a historical overlay, so we know where the machines are going. We know where momentum's going. And let's take a look at the market here, because one of the risks as we go into earnings season, which says that if these companies don't hit some big numbers, you're going to see the market come down. That's why you're not seeing a breakout here of all-time highs. We got this low back in September. It hit this 6 month volume profile. Now, if you're not familiar with this red line is, that is the volume profile. What it tells us is the most shares traded over a period of time right there. So what happened, it came down into support, buyers stepped in and bought. Now, you notice we don't have a position here from our reports, and there's a good reason. We got stopped out of those positions because we know there are air pockets coming in October. It's too much a risk. So rather buy on one of those dips than be in ahead of time. Now, let's take a look here, because what this suggests is when we look at the long-term momentums of the market, there's some risk here. Let's zoom out to the weekly, because what I want you to see is going back to this huge rally here, what happened, the market was overbought for extended periods of time, and then it started to slow down, but people remained bullish. They kept buying, and then all of a sudden the market came down. You're seeing the same setup here. Market's overbought on both the MACD and the RSI and starting to slow down, suggesting that investors are front running something that's not going to play out the way they think. So let's take a look now at, of course, what we see on the tech stocks. But before we do that, you might be wondering, how do you make money using our reports? We're simple. Here's how we beat the machines, because when the machines get short the market and price moves against them, they have to buy. Here's a trade that's not even been on the books a month. We're up 17%, and we give you all the data when these signals come out. It's so easy. And right now, going into Monday, we've got 4 open trades, 100% win rate. You know, we're being cautious on this market for good reasons. On a momentum basis, we got 6 open trades. Half of them are up. Well, that is outstanding. We added 1 trade for Monday. We think there's some movement there on that. And here's what you get, the reports. You get the signals. I go through every signal and tell you what trades to do. We even back test our reports to show you how great they are. We give you stop loss levels to control your risk. We track everything for you. We give you updates on stop loss levels every week. All you have to do is place the trades, and here's the best part. It's fully duplicatable, and you get a 30-day free trial. You can make money in the market. It's not hard, that, friends. We make it just that easy for you. Let's take a look at tech stocks. Now, remember, these are the biggest buyer of stocks in the market. Momentum's still positive here. We see the RSI is at 60. MACD's got a positive cross. 17 consecutive daily buy signals here. Again, we don't have position because we know they're in blackout. We know there's going to be an air pocket here. Upside target's the all-time high. Downside target 471.05. Let's take a look here at QQQ, and that we need to look. And what do you see? It's right here off the 6 month volume profile. Buyers came in, but notably, unlike the S&P, which is right near its all-time high, you're not seeing that here with the Qs. And what the risk is we're likely to see the sell down some. If there's an air pocket, the target would likely be right around the 200-day moving average or 439. You can see, again, anything, if you see these companies miss earnings in a way You're going to see this come down. That's going to create your buying opportunity. But the risk here is, again, everybody's in, suggesting there's nobody left to buy. And we see that with small caps too. Momentum here is still positive. Even though the MACD's got a negative cross, we see 16 consecutive daily buy signals on our Momentum Timer Pro. And that's due to a proprietary overlay that takes away all of the fluctuations in these technical signals. But look at machine positioning, starting to back off a long position here. And again, you know, we're not exposed much here to the equity market. And again, for very good reason. Let's take a look at IWM, because there was all this excitement. All of a sudden, you see, of course, market taking this thing higher, got rejected, came up, once again rejected, shot up again, rejected. Sellers here dominate, and if you can't push past the wall of sellers, it tells you price is going to come down. Find where buyers are at. And right now, that's right around the 200-day moving average. You see this volume here start to pick up. That's where buyers at. We're seeing this happen in IWM. It's starting to roll over, because if you zoom out, it just didn't get up here. We were hoping it did, but look at that. There's a 5-year volume profile suggesting people that were sellers back here, they're sellers here once again. Again, no catalyst to drive them higher as we go into earnings season here. How about the banking sector? Because this is one of the places that B of A knows that customers are going to, because rates are coming down. But here's the thing, lower rates is not bullish for banks. You think that if they're down, then that means people are coming to borrow more. But here's the part. Financial conditions get tighter as rates go down. It doesn't mean that banks are eager to lend. That isn't stopping money from flowing in. What do we see? One consecutive daily buy signal after 3 sell signals. Look at machine positioning. We're seeing it back off here, indicating that perhaps you don't want to really be in bank stocks. Now, remember, we made some money on a trade here not too long ago in the banks. We've got the RSI at 52. This is slowing down. MACD's got a negative cross. Let's take a look at KBE here and see what's going on, because look at the technicals. There's definitely clearly signs are slowing down. You see that kind of triple top pattern that showed up in small caps. Again, you see these 2 purple lines? That's called a supply zone. Now, what's happening right here is you see sellers here, and that's what's happening. They're going to push down to the 100-day moving average, this blue line. You breach through that. The next level of support here is down here at 46. So what you're seeing here, broadly looking as we look at momentum and machine positioning, is that markets are extended. And so this is what we see from Hartnett, kind of warning about, hey, if you're long the U.S. equity market here, maybe you ought to look at some repositioning. And one place investors have been going, well, they're headed over to REITs, because they think that real estate sector is going to take off on lower interest rates. But remember, financial conditions are tightening here, and just because rates go down a little bit doesn't mean people are going to flood in and buy homes. We see sell signals on momentum, 3 of them in a row after a comeback. Look at this, maxed out on the 1, 3, and 6 month. When you see max momentum, you're starting to look the other direction. In fact, what do we know? RSI, not under 40, but headed that way. Following the MACD lower on a negative cross, machine positioning starting to back off on our fast algorithm, again indicating that there's selling here that is coming that people can't see. Let's take a look at VNQ. What do you see? This is a chart where money is flowing into, and it's going down. There's a lot of risk in this. Let's zoom out the 5-year chart. It's not even back at all-time highs. It came up here, ran into some resistance, and is now coming down. It's putting the next targets here. The support levels are going to be right here around 88. This is where we see prior zones of where sellers are at. The question is, will buyers come back in right here where they did before? Or will they turn into net sellers? That is the risk. You see here, sellers here, and then they turned into buyers as it took off. That is your support level. Look for a return to 88 here, and if lower rate cuts don't lead to big surge in home purchases, well, watch out, because where is Hartnett telling us? Where has he been suggesting people look at? It's the bond market. Now, why does this make sense? Because if you believe that the Fed is at the beginning of a rate cut cycle, which they say they're not, but we know history says they are, well, the money's to be made in the bond market. What you see is that when the Fed starts to cut rates, it's not bullish for equities. People believe it is, and then it turns out the reason the Fed's cutting is we're headed into a recession. But look at this. What he's saying, allocations in cash for their investors are remaining near very low levels historically. How about into bond market? Well, we see people buying 2 to 10-year notes. They're cutting their T-bills, but look, no exposure to long bond. And that's what Hartnett's saying, is that's where you got to look. How about CTA positioning? What do we see the machines on the fast algorithm? They're long. On the slow algorithm, they still got buyers here. Goldman, notably one of the slower type of machines we track on our reports, but in a down tape, They could be big sellers of bonds. I don't think that's likely. We'll take a look at what range you need to see here. No, Metre, they're on the fast side of the algorithm. They're max long here. You don't see selling until it breach 111.17. Let's take a look at TLT. This is the long bond ETF. And what are we looking for? Is this thing going to find support? Relative strength index 33. MACD got a negative cross. Now you want to be buying when technical indicators are actually at a low point and start to switch. We want to look at machine positioning here as well. What do we see? We now see a short position on our fast algorithm. This is fantastic because when this flips, it's going to indicate to our subscribers a buy signal. We'll review it for them, but look at this momentum still to the downside. We're going to watch for a flip here too. Now we traded this one without stop loss. We always recommend that. Our trade's still up 1.65% because we got it on the wrong side of this trade and we just dollar cost average in as our signals told us to. But look at this, 11 consecutive daily sell signals. Upside target been revised down to 97.97. Hit our downside target. We pushed that down a little bit. Let's take a look here at TLT. Is this thing likely to come to a stop? The answer is, well, it is. And here you can see, because when we look at this 1-year chart, where do you see the volume profile? It's right here. And what is that telling us? All this is beneath here is buyers. And you can see buyers coming in, buyers. But what's happening up here? You see sellers right here, sellers right here, sellers again. Now, when that gets cleared out where those two dotted green lines are, watch out because there's sellers here too. When finally all the sellers are exhausted, this thing's taken off to 109 because you see how fast it moves between those zones. And if you see this volume here, let's zoom in again. And what do you see? The support is right underneath here, right at the 200-day moving average. Wouldn't surprise me if we see a little more downward pressure and then a reversal and then breaks that 6-month volume profile, likely off to the races. So where this settles, this is where you want to be looking to perhaps move some money out of the equity market into bonds. But many people are bullish on gold. We didn't see a lot of B of A clients buying gold here, but look at this. 41 consecutive daily buy signals, maxed out on the 1, 3, and almost are on the 6-month window. Where does this go? I don't know. Many of you comment, do you think gold's going to the moon? Maybe you're right. But what do we see here? Momentum starting to slow down. Machine positioning super long. What does that look like for gold? Let's take a look here at GLD. What do we see? This thing is just going up, up, and up. The question is, when does this reverse? We don't know. But what we can see is momentum here is coming off overbought territory. In the past, when that's happened, it's usually led to a pullback. That's why we're suggesting pullback here right around that 50-day moving average in green. You see the volume support here as traders were last buyers there. So we do see that. We see some selling up here. Let's zoom into the 10-day window. What do you see? Selling here above. So again, making the case gold likely to pull back. If you're looking to buy into gold, hang tight. I think you'll get a little bit of a better opportunity. How about gold buyers? Are they giving us some indication where gold is going? We'll take a look because what we see here again, momentum slowing down. Although we do have 17 consecutive buy signals, we'll see where that flips. Machine positioning here, super long. Let's take a look at GDX. What do we have going on here? And we see a series of higher highs. This is great news. This is what you want. And higher lows. This is exactly what you want. The problem is we zoom into the 10-day window. What do we see? Selling above. So this is creating a pullback scenario here, just like we're seeing in gold. I would look for 37.67 to be your next target. If it gets down below that, you want to see a hard stop on this if you see a bigger sell-off at 33.95. You see it? If it gets down that low and it holds, of course, we'll talk about it on the show. You want to look to be a buyer there. But in the short term, look for it to get into this range here, 37.67. Now let's talk about what's going on with the dollar, because there are opportunities in other places. The dollar, well, this was a trade we missed because, of course, you get bearish signals when the Fed cuts rates, and that is not something you want to play chase. But the market tossed the dollar up in a huge way. Let's take a look at this. 25 consecutive daily buy signals on the report. We see momentum maxed out on the 1 month. That's obvious. Machine positioning shot higher here as everyone looked to get out of their short positions. Let's take a quick look at the dollar and show you another one of our big winning trades. That is in soybeans. Let's find the dollar. Where is it? Oh, it's down here. There it is. And look at this, came right out of this kind of double bottomish pattern and took off like a rocket, but it's running into sellers right up here. You see a 6-month volume profile at 28.82. hard rejection here. Again, Fed looks to cut. You're going to see people selling the dollar. This was just a reaction as people who were short got squeezed out of that trade. But one trade we think is got a lot of upside. Let's take a quick look at oil. I think this one's overbaked as well. People are chasing oil higher. I don't like this trade that much, but maybe you do. I've read in the reports tons of people want an oil. It's breaking out. I think there's limited upside here. Maybe it gets to 80, 84. Maybe it just runs out of steam here. We'll see what the data suggests. It could just be a reactionary move out of a big short position. But let's take a look at the trade we're excited about, and that is soybeans. This trade's up 4.81%. This was a pair trade. It triggered on the same day on our CTA Momentum Time Pro reports. Here's our active stop loss levels. You see momentum shifted here, and that was the key sign. We saw machine positioning come out of deep short levels. We saw machine positioning change. This was one you could have made a lot of money on. It still can, because what do you look for here on a trade? You see it bottomed out here and took off. Now, when you zoom out to the 1-year chart, we said, look at this thing. Let's go to the 2-year chart, because it came way down. It hit support. In fact, we got to go to the 5-year chart to actually see it. And there you get the picture. It came down here to support, and you've seen it's taken off here. And it's doing the same thing. We said, look, this is opportunity. Our reports flagged it. Now, when you get across of the 50-day moving average, you don't be surprised if it comes down and retouches that and takes off. And where is that volume sitting? Right here at the 50-day. That thing's going to start curling up. So what do you see? Machine positioning telling you this is good. Momentum is telling you this is good. And you see the moving averages support here. Not surprised we're seeing a little resistance at the 100-day. It's going to pull back into support. If that holds and takes off, look to add another position or to take one altogether. Again, if you're a subscriber, you would have been in on this early. We give you all the tools to be a successful trader. Links in the description below. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.